Afternoon or morning, I guess, depending upon where you find yourself in the country. Like myself, I'm enjoying the Montana summers. So I hope everybody enjoyed their 4th of July weekend celebration. Thank you all for joining today. My name is Keith Duran. I'm Senior Vice President of Business Development, and we're joined by Jim Warner, who's Head of Research and Co-Portfolio Manager. For those that are new today to these webinars, these are a little different than most firms. We, yes, provide this sort of macroeconomic backdrop of the economy and the market updates, but we go a bit farther in that we provide how does this information apply to our themes and the holdings that are in our portfolios, and that will come later in the presentation. We encourage questions which can be directed to us at the bottom of the screen. There'll be a little Q&A button. Please ask the questions throughout the duration of the presentation, and we'll address those at the end of Jim's prepared remarks. So without further ado, I will turn it over to you, Jim.
Great. Thanks, Keith. Thanks to everybody for joining us today. Let me go ahead and share my screen as I normally do. All right. So we have been referring to, what's been going on in Iran and that conflict, the high oil prices due to the closure of the Strait of Hormuz, the implied threat to higher inflation and therefore higher interest rates as essentially the storm. And the storm appears to have largely passed. Yes, there's some additional commentary today from Trump about trying to drive the Iranians to the bargaining table. You're seeing oil prices a bit higher today. And we think that that is probably more the norm. But by and large, essentially, we think that the storm has passed. Although we are keeping some energy hedges in the portfolio, which I'll talk about here in a minute. All right, so let's start first by just going through performance. It's really pretty much the same as where when we last met about a month ago. Our moderate flagship strategy, Global Vigilance, is up 7.3% year to date. These are returns net of fees. And I think the end up 21% over the last year. And what I always point out is the since inception, which is now about 11 years, is at 8.7%. So this is why many clients enjoy this product over the years because it tends to compound at a nice rate that really helps grow wealth. Tilt, our more aggressive version, is up a little bit more for the year. It's only been around for about 3 years, but it has obviously done quite nicely. Our ETF moderate strategy, which essentially is the same secular themes that we use in our regular Global Vigilance, but is just only expressed using ETS, which is it's better for kind of really small accounts, is also having a nice go. And our conservative strategy is actually doing fairly well as well. Basically, our strategies, regardless of risk tolerance right now, are just slightly below where the S&P is, but obviously way outperforming the U.S. aggregate bond index, which really has been a drag in every portfolio. Any portfolio with bonds has really had a difficult time this year, really essentially flat performance. So what we're going to cover today is we're going to talk a little bit about what was a record quarter this past June quarter. And then we're going to, and there were some interesting changes and rotations that happened within it. So we'll discuss that. And we'll talk about what's driving the markets as a result. And then we're going to talk a bit more about AI and why we're still in the very early innings. So while we've had little bit of a pullback in the last week, few weeks, we think this is a huge buying opportunity because this is a build out that is going to last for years, if not decades. And then finally, we always finish with our portfolio strategy. In other words, what are we doing about it in portfolios? And we'll talk about that. And then we'll take some time at the end for Q&A. So feel free to use the Q&A button at the bottom of your screen and type in your questions. They are anonymous and we love to take them. All right, so Q2 was the best quarter we've seen since Q2 2020 when the market was recovering from the huge drop caused by COVID. So put that into perspective. Now, if you pull back the covers a bit, it's really pretty interesting. Really, it was all driven by semiconductors. The semiconductor ETF SMH was up 71% during the quarter. And that's even including the bit of the pullback that it had in the last week or so of the quarter. NASDAQ, not surprisingly, was up a bunch, up 21%, 22%. The S&P was up 15, which is a remarkable quarter for the S&P. But interestingly, it was not propelled by the Mag 7. The Mag 7 was only up about 12%, so less than the market, which is really interesting because if you think back for the last few years, the market has largely been driven by the Mag 7. And so, to see them take a step back. Now, one of the reasons for this is that within the Mag 7, right, you have a number of hyperscalers. And the narrative during the quarter was essentially you don't want to own the hyperscalers because they're the ones that are paying out all the CapEx, to build these huge AI data centers and AI models. You want to buy the folks that receive that money. And of course, we have that exposure in our portfolio, like others. What is also interesting is that the S&P 500 equal weight. So this is where you minimize the impact that the Mag 7 has, and you look kind of more broadly at the index. It too was only up about 11%, so underperforming the actual index itself. So it was this very small number of chip companies essentially that were driving the whole quarterly performance. And then, of course, as I mentioned on the previous page, the bonds did nothing. So June was very interesting, though. While the semiconductor index was still up, it really pulled back pretty significantly. And I think what we began to see was a broadening out of this market, which is great. It's better to have markets where more of the market is engaged. And you can see that with the equal weight here. It was actually up 2.4%, outperforming the S&P, which was down 1% pretty significantly, and way outperforming the Mag 7, which was down almost 9%. So what this means is that people are moving into other parts of the market, which is great. And I think part of what's going on here is with the with the view that there is ultimately going to be some resumption of the oil trade through the Strait of Hormuz and some resolution to the Iranian conflict, although who knows, we might be firing at each other for quite some time now. But so long as the risk to the global economy from dramatically higher oil prices is mitigated, people can now start to look towards some of the sectors that hold really a lot of value, like industrials, like financials, and even healthcare. And we're going to get into that in a bit. So what's really driving the market right now is first and foremost is falling oil prices. Now, putting today aside, we got down to a pretty low, we got, WTI down to $69 just as of a couple days ago, which, as you can see in this chart, the oil price is the dark line. It's way off the highs that were experienced, during the height of the Iran conflict. So the market is starting to normalize that. And remember, this is the front end of the curve. If you look out the curve into later dates in the futures market, oil is actually pretty much normalized into like the $50 area. So what that basically tells you is that whatever, this whole conflict is essentially a blip on the radar. That things will eventually normalize. Now, I'm going to talk a little bit more about our view on what oil prices are going to do out, say, a year, which is different from the markets. But for all intents and purposes, what's driving the market higher is the ability to say, okay, we're going to take the inflation, the GDP threat, and we're going to take that off the table, and we can now revisit some of these more secular stories. Just to point out, the kind of yellow orangey line, or gold, I guess, is the 10-year Treasury yield. And what you can see is, yes, there was a pop when the inflation narrative was at its peak, and we're off that peak. So I think what you're most likely going to see is some migration back down, to the lower, kind of in the lower fours as we were pre-conflict. We may not get there all of a sudden, but I think that's the general trend is gradually slightly lower rates. So as I mentioned, there was a bit of a rotation, and there wasn't just a rotation out of AI. There was also, not surprisingly, a rotation out of energy as oil prices came down. Now, obviously, what energy stocks did initially was they surged because oil prices surged. That makes sense, and they're going to come down when the front end of the curve, sort of falls back. But remember, energy is, these companies are going to be very, very busy over the course of the next year as global oil storage levels are at all-time lows. The US SPR is at all-time lows, and many other foreign companies that tapped into their own strategic petroleum reserves need to get refilled. And so we think that there is a very likely chance that there is a very broad amount of additional demand that will be experienced. And so it's very likely that we could see oil prices higher than where the curve implies out a year. And so one of the things that we've done, and I'll talk about this a bit more, but is we've actually added to energy, given that even after this pullback, because we think that there's great value there. These names actually act as great hedges, like on days like today when something goes, crazy, over the Strait of Hormuz and the oil prices, increase. But we also think there's great value. If you look out to 2027 and 2028, that there could be a very interesting amount of excessive earnings that they can earn given the underlying demand that we see for oil. The other thing that benefited during this rotation was healthcare. Now, healthcare is basically the biggest laggard in the S&P if you look at the sector over the course of this year. And, it has gotten, in many cases, to very, very interesting levels. As I'll talk about here, we have been adding a lot of exposure to healthcare. And one of the principal reasons is that we think that it will be one of the prime beneficiaries of applied AI. And companies like Lilly are in the kind of bullseye of that type of a trade. The other thing that has gotten a bid recently is financials. And that makes sense because when you get more cyclical clarity, you tend to see less concerns over credit, more demand for loans, generally positive GDP or positive views on GDP lend themselves directly to banks and other financials. And just to take a look at this AI pullback, if you pull back and look at what this happened. Now, what's interesting is that most of these pullbacks started at the very beginning of June, maybe the tail end of May for some. And they have, basically gotten to the point where they have bounced. Maybe they haven't, maybe there's another leg down, but some of these are really significant pullbacks and we're certainly considering, buying this dip. But Oracle, for example, we don't have a position in this, but it's down. It went down 44% during this period. Salesforce, and one of the issues, obviously, with Oracle, just to touch on that, is that one of the narratives. So stocks go down for usually two reasons. One is its fundamentals. So there's something fundamentally different, or something has changed or gotten worse. And if you step back and you think about what has gotten worse in the AI trade, is really not much. And frankly, we've seen, and I'm going to address this in a minute, we've seen, token prices come down, but there's an explosion of demand that's happening. And so therefore, all these plans for data centers and whatnot seem to be, well intact. And so any sort of fears that say, OpenAI may not be able to pay Oracle what they've promised, I mean, there is a probability, there is a chance of that. But to price in a 44% decline is pretty dramatic. And so a lot of these names have pulled back to levels where the risks, the potential rewards far outweigh the risks, and where we really haven't seen an erosion of fundamentals. You can say the same thing with Micron, which pulled back 20%, with Broadcom, which pulled back 25%, and even with Google, it pulled back 16%. Now, the two outliers where, and then this, and the, so what's really driving those pullbacks is the other reason a stock falls, which is just sentiment changes, you know, and and that can change simply on a whim. It can mean that these crowded trades, and we've talked about crowded trades all year, right? Where a lot of times these AI names, they get super crowded. Basically everybody buys them, and you get to a point where not even incredible news the stock doesn't even go up on incredibly good news. And we saw that last night with Samsung and just, blowout numbers. But the stock's up 90% this year, so of course it went down 9% on the print. These are the sort of things that you're seeing. So you're still seeing great fundamentals. So it's really just a function of just more sellers than buyers, and that technical sort of pullback is something that you generally want to buy. Now, the two that are maybe a little different on this page are CRM, Salesforce, and Microsoft, and they are sort of, and maybe you could add Oracle into this a little bit. They have been somewhat caught up in the kind of negativity around software and the narrative that AI will replace a lot of software vendors. And the reality is that may be true, that some software vendors are going to have a difficult time um, withstanding the challenge from AI, but there are others that we think that are so core to enterprises. They're just mission critical that you can't leave it up to some vibe coder in your back office to come up with some replacement. And so, I think there is an option to buy some of this software dip, but you're going to have to be very, 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 very specific. And but meanwhile, what happens is a lot of times is the negativity around a space can drag even the good names down, and that's where you find a lot of opportunity. So, we're doing a decent amount of work trying to pick out, some of these fallen angels, if you will. So let's just talk a little bit about AI because there's been a lot of conversation, certainly if you listen to CNBC on is this a bubble, and I thought we'd addressed this before, but apparently there's still a narrative out there that that this isn't real. I mean, to take a step back, I mean, one of the things that NVIDIA's CEO Jensen Huang has offered as a way to picture the entire AI stack is to what he calls a five-layer cake, where you've got silicon chips on the bottom, then it moves into the hardware, then into the cloud, that's your data centers. Then you have your platform and frameworks, and ultimately applications and services. And so if you look across the stocks that are in those five different categories, there's been tremendous outperformance across all of them, and even during this past quarter. And so, and so you, and it's because there's this insatiable demand for tokens, and we'll talk about that here in a second. But then another way to think about this ecosystem, and this is how we think about it. It's a little bit more detailed than Jensen Huang's version, but it's very similar in nature. Is first, you have to look at the inputs. So the silicon and what goes in the silicon and the copper and the rare earths and all the things that you need to make these chips, to create these data centers, to generate the electricity, to electrify them. All of those things are needed. Then to train your LLM and build your LLM and create so that AI compute then gets turned into intelligence. And then finally, and is the application. And this is where you have, these chips are making their way into eventually, on the robotics is coming, autonomous driving is here and growing quickly into software development, of course, healthcare. We think there's an enormous opportunity to apply healthcare for drug discovery and things like that. Financial services, AI will be super useful in credit underwriting, for example, or in insurance, and then various other applications. And we invest across all of this. And so when certain certain areas of these, stocks that are within these areas certainly can get to a point where they get crowded and they get overbought, but the fundamentals are still there and they're feeding a dramatic number of companies, not just tech companies, but also industrials. And so, you'll find in our portfolios that we pretty much touch on all of the things that you see here. So the one bear case that has popped up recently is that token prices are falling. Now, what do I mean by that? So whenever you prompt AI, basically what happens is that your prompt and then the is tokenized, and then what you receive back is essentially is a response, which is assembles essentially all these tokens. And so that's the best way to I think judge the volume increase in the usage of AI. And what you are seeing is that as time goes by and the chips get more powerful, the token prices themselves get cheaper because it's cheaper to make them. The cost of running these models is dropping dramatically. But if you ever heard the term Jevons law, what basically that means is that you're seeing way more demand, and the speed of which the demand is growing is far outpacing the decline that you're seeing in pricing. And so that means good things obviously for revenues, which means you're going to get very positive ROIs on that huge CapEx spend. I mean, one thing to also consider, this is kind of where we're going in terms of our some of our newer ideas, is who benefits from what is going to be an explosion in tokens. So one of the things that's just now happening is that Gartner put out a report recently said that 80% of corporations are building AI agents. Now, and there's very few that are frankly out there right now, but an AI agent consumes, studies show, somewhere between 5 and 30x the amount that a heavy individual person creates. So the token generation is 5 to 30 times more than a human. And we're about to see an explosion of AI agents. And we're going to even get to the point where AI agents are talking to AI agents and they're generating tokens between each other. So what we will see is going to only be measured in in logs. So this logarithmic demand explosion is what's really propelling all of this. And we are just in the early innings of it. So let's just talk quickly then about portfolio strategy. So what are we doing about all this? And then we can take your questions. So in our global vigilance moderate strategy, we are leaning into this broadening. We have essentially doubled the size of our healthcare sleeve by adding more to Lilly and into XBI, a biotech ETF. This is as I mentioned before, this part of the market has been lagging for some time. We think it is very overlooked. If you really dig into, say, what Lilly's doing on the AI side, it is really transformative. And that's what we're looking for, is we're looking for companies that can transform themselves with the application of AI. And I don't mean, by the way, just cutting heads. This isn't just about reducing the number of employees. This is about, building, better drugs. I mean, maybe cure cancer. I mean, you can think real big when it comes to what good AI could do. And we think we found at least one stock for now that is on the right path. I mentioned our deliberate energy hedge. So we added FANG, which is Diamondback Energy. They are a best-in-class, low-cost domestic producer. If, on days like today where there's a hiccup in the, Iran talks, oil goes up, this stock goes up. If this all gets resolved, the stock will go down and we'll be pretty happy because the rest of the portfolio will do great. So it's a great hedge. And then if you layer in this thesis that 2027 oil prices are going to be higher than what people currently think, that actually FANG is very well positioned to benefit from that. We've also, added an advanced materials stock, which is really at the front end of the supply chain for AI and the chips required. And then we've also been done some rotation within precious metals. As you know, for those of you who've been following us for a while, for the last few years, gold has been a really important hedge and really an important performer in the portfolio. And we've essentially been reducing that position size. And with the line of sight to some resolution in Iran, we think that we can get a little more leverage to a recovery in precious metal prices by shifting into silver. And that's exactly what we did. All in all, what we've been doing essentially during June is reducing our cash and deploying it. Because as you know, as many of you know, we came into June a little heavy on cash. And for those of you who are new, I mean, what you should understand about us is that we are tactical investors. So we don't just, fire and forget. We actively manage the portfolio. If it's the right time to hold silver, we buy it. If it's not, we get out. If it's the right time to own more stocks or more technology, we buy it. If it's not, we sell it. And this is so we are actively managing the risk in the portfolio. And for those of you who are clients, you see it in our trading patterns. But that's an important distinction to make between us and maybe some of the other investment firms that you've observed. In our tilt, which is our aggressive model, same sort of movement of deploying cash into healthcare, into in this case a Chevron, an energy name. And also, we initiated a position in a general robotics and automation ETF. That is really where this is all going. The total addressable market of robotics in general in this country is about to explode. And physical AI is going to be the place to be. I mean, we already own Qualcomm for that reason. We own Tesla in some portfolios for that reason. And so that's a really important theme that I think you're going to hear us talk a lot more about in the future. And then in the conservative, we did also reduce our cash, deployed it into healthcare, a little bit into technology, and then into some shorter duration high yield. So all of this basically reflects essentially these moves that we've done recently reflect really four themes. One of these is the golden age of healthcare. As you know, we've been a fan of healthcare for a while, although it's been a relatively small part of the portfolio. That is obviously now increased. And I think it's part of a broader push to find places that are not specifically technology companies, that are in other industries that are or can apply AI to transform their businesses. So I think you're going to hear us talk a lot more about that in the future. The second is, of course, the AI trade and addressing the whole stack and all of it, and all the way down to the advanced materials and all the way out to the application end, like robotics, are still up. There are still great opportunities. In fact, even after this pullback, Nvidia looks like a screaming buy. We already own it, but it's actually Nvidia is now trading. We looked at it this morning at the lowest PE it has ever traded at since coming public, which is astonishing given how bright the fundamentals are there. A bit of a broadening in the metals trade, and then obviously we've got a bit more cyclical clarity, with some wind down with the Iran conflict and lower oil prices. So what's next? Storm clouds are parting, we think. The falling oil just means that there's fewer things to fear. We've got a resilient economy. I didn't talk at all about the labor market, but it's very resilient. We're still adding jobs. The unemployment rate's still low. There's still a lot of very good things that are happening in the labor market. And then of course, this AI cycle is still in the early innings. And so when you really step back and you think about the massive amounts, I mean, we think that the hyperscalers are spending roughly around $850 billion this year on their AI build out. We think that number may go to 1.2 to 1.3 trillion next year. That's first of all, that's a huge increase on a percentage basis. So we don't think that we're anywhere close to sort of a slowdown in hyperscaler spending, and therefore all the other, follow-on benefits that money delivers to various different businesses around in various different industries. And what's more, there's still, remember, a lot of fiscal stimulus flowing through, whether it's the Big Beautiful Bill or whether it's, the Infrastructure Act. That still hasn't that money still hasn't been deployed. There's still, we're talking hundreds of billions, if not trillions of dollars of fiscal stimulus that has still yet to flow into the economy. So there's still a lot of very positive things to be thankful for and to look forward to in terms of GDP growth for the rest of the year. So we're putting our money back, our capital back to work, but very deliberately, as we always do. So why don't we pause there, Keith, and see if we've got any questions.
Sure. And the consumer is still spending, yes?
Yes, and the consumer is still spending because they have a job. So yeah, there's a lot of good things to point to.
So, as I know that, at Lear, we're huge, AI users, just probably between you and Jim, you and Rick, how many agents do you think you two employ?
It's a lot.
Yeah.
We certainly use it for mining, for research, for news collection. We use AI for, proposals. This presentation, a lot of it was generated by AI. It's what I say to people, and this goes to also the other question of like, well, is this going to lead to fewer employees? Well, we keep adding employees for one thing, and it's because we can do more and we can generate more business and we can generate better investment ideas. And from purely a research and investment hat that I wear, one of the terrific things that AI does is it increases the velocity of my ideas. And back when I was at Citadel, that was one thing that we always talked about was idea velocity. The more ideas you have, the better the ideas are going to be that are in the portfolio. And as you know, because we limit the number of ideas in our portfolio to 30, that means that if you want to get a name in, it's got to be a better idea than something that's already in there. And again, that allows us to really make sure that we have a best of portfolio at all times.
Gotcha. Well, this is an opportunity. I don't see any in the queue, but I'll give it a second just to see if somebody wants to ask something uh, uh, to Jim or to Lear Investment Management. Um, I guess not. Sometimes I guess when if I ever deliver a presentation and nobody has any questions, you know what that means. It's just that you did a fantastic job and there's absolutely nothing to ask.
Oh,
Uh,
great.
all right. Well, listen, since there are no questions, thank you, everybody. I can't believe that the first half of the year is over already. Man, we're in July in the second half. This presentation will and can be delivered to you once it's been through compliance, along with the slide deck. You can also reach out to us at any time if we can be of help, or if you'd like to request this and somehow you get missed. So, other than that, Jim, thank you very much. Y'all enjoy the rest of your week, and thank you again for joining.
Thank you.